Capital expenditure and revenue expenditure. Dear students, today we will discuss about distinction between capital and revenue, capital expenditure, revenue expenditure, items chargeable to revenue, items chargeable to capital, and exceptions to the general rule on various items of expenditure. Distinction between capital and revenue. The distinction between capital and revenue expenditure most vitally affects the fundamentals of accounting, and it is highly essential, therefore, that the proper adjustment of these items must receive close and careful attention at the time of preparation of final accounts. In view of the fact that while constructing the final accounts, all revenue items would have to be included in the revenue account, that is the profit and loss account, and all items of capital expenditure will form part of balance sheet. Misclassification, if any, would falsify the final results as disclosed by both the profit and loss account and the balance sheet. For example, it would be fundamentally wrong to charge repairs and renewals to plant and machinery account to debit additions to buildings, plant or fixtures to repairs account, to debit purchases account with the amount expended on office furniture, or to credit the amount realized on the sale of any fixed assets to sales account. All expenditure which results in the acquisition of permanent assets which are intended to be continually used in the business for the purpose of earning revenue is capital expenditure. Further, any amount expended which tends to extend or improve existing assets so as to enhance the revenue earning capacity by increasing production or reduction cost of production may rightly be treated as capital expenditure. Thus, the cost of land, buildings, plant, tools, fixtures, and similar assets acquired by any concern by way of permanent equipment, so that with the help of this business may be carried on, would be treated as capital expenditure. All establishment and other expenses incurred in the conduct of and administration of the business come under the heading revenue expenditure. Further, all expenses incurred by way of repairs, replacements, and renewals of existing assets which do not in any way add to their earning capacity but simply serve to maintain the original equipment in an efficient working order are properly chargeable to revenue. Thus, office salaries, rent, taxes, insurance, advertising, and other expenses incidental to the carrying on a business, as also amounts expended on repairs to assets forming part of permanent equipment, would be treated as items of revenue expenditure. Items chargeable to revenue. The following items are usually chargeable to revenue. 1. All expenses incurred in the ordinary conduct and administration of the business, such as rent, salaries, wages, insurance, advertising, etc. 2. Expenses incurred by way of repairs, renewals, and replacements for the purpose of maintaining the existing permanent assets of the business, such as works building, plant, machinery, tools, fixtures, etc., in a state of original work efficiency. 3. Cost of goods bought for a resale. 4. Cost of raw materials and stores required for consumption in the course of manufacturing. 5. Wages paid for manufacture of a product for sale. 6. All other amounts expended in the manufacturing and distribution of the products handled. 7. Loss arising from wear and tear and obsolescence of assets utilized in business. 8. Annual amount to be written off the lease. 9. Interest on loans borrowed for business. 10. Loss arising from sale of fixed assets. 11. Annual fees paid for renewal of patents. 12. Maintenance of office car or motor van, including replacement of tires, tubes, wheels, etc. 13. Maintenance of electric lights and fans. 14. Book value of assets discarded or totally damaged or destroyed by fire or other reasons. Items chargeable to capital. The following items are usually chargeable to capital. Cost of goodwill, cost of a freehold land and building, cost of lease acquired, cost of plant machinery, tools and fixtures acquired for equipment, cost of trademarks, patents, copyrights, patterns and designs, cost of office car, motor van or lorry, cost of installation of lights and fans, cost of any other asset acquired by way of equipment. Expenses on erection of plant and machinery, actual additions and extensions to existing assets, structural improvements or alterations to existing assets whereby their revenue earning capacity is increased. Development expenses in case of mines and plantations. Administration expenses in industrial enterprises incurred during the period of construction and equipment. Cost of experimenting when the same results ultimately in acquisition of a patent. Exceptions to general rules. The following are exceptions to the above general rules. 1. Legal costs and architect fees. These are, as a rule, revenue charges, but legal charges and stamp duty paid for convenience on acquisition of property and architect fees paid for supervising construction of a property can be capitalized as they form an additional cost of the asset acquired. Brokerage and stamp duty. Normally, these are revenue items, but brokerage paid on acquisition of property or on purchase of shares, stocks, or other securities, as also the stamp duty involved thereon, can be treated as an additional cost of the purchase and capitalized. Parliamentary expenses. Parliamentary expenses incurred in promoting bills for granting license to railways, tramway companies, gas works, electric lighting companies, and such other concerns are capitalized under special acts. Production wages. This is a revenue charge, but in manufacturing business where the firm's own men are employed in making extension to the factory building or in erecting plant or manufacturing tools for own requirements, the wages paid for such purpose would be capitalized. Repairs. Repairs and renewals are normally treated as items of revenue expenditure, but if an old property has been acquired in a dilapidated state and an amount is expended to put it into a tenable condition, the same can rightly be added to the cost of the asset. Similarly, if an old machine is purchased and a sum is spent by way of repairs and replacement to put it in a running order and thus render it revenue earning, the same can fairly be treated as an additional cost of the machine. Advertising. Ordinarily, amounts expended on advertising own factory products or other goods dealt in with a view to enhance the sales are chargeable to revenue. But where a newspaper concern expends abnormally heavy amounts on advertising in the beginning of its career, or where a manufacturing concern advertises largely its patented products at the initial stages of the business, this may have the effect of creating a future goodwill and may be capitalized. Interest. Although ordinarily a revenue charge, interest paid on subscribed capital by public utility concerns during construction of works is allowed to capitalized by statute under certain terms and conditions. Freight and carriage. This is a revenue charge, but freight or carriage paid on a newly acquired plant or similar fixed assets will form additional cost of the asset in question and will be capitalized. Development expenses. In concerns like collieries, mines, tea, rubber, and other plantations, all expenses incurred during the period of development and up to the time they begin to earn are charged to capital. Preliminary or formation expenses. These are initial expenses incurred in connection with the formation of a public company and the obtaining of the share capital. The expenses, although revenue in the nature, are allowed to be capitalized and can be shown as an asset in the balance sheet under the Indian as well as the English Companies Acts. There is nothing, however, to prevent their being written off against profits over a period of years, and it would be sound and prudent to do so, provided there are sufficient profits to write off these. Underwriting commission and brokerage on shares. These items are equally of a revenue nature as above, but are allowed to be capitalized and can be shown in a company balance sheet as an asset under the Indian and English Companies Act. Cost of issue of debentures or a discount on issue of debentures. This item represent expenses or loss arising at the time of issue of debentures by a public company, and although revenue by nature, it is allowed to be temporarily capitalized and apportioned equally over the number of years for which the debentures are to turn. Additions to leasehold. Addition to a leasehold building is a capital expenditure and can be debited to leasehold account. But the cost of original lease as also the cost of additions there must be charged off to revenue equitably over the period covered by the leasehold. Expenses relating to patents. All expenses relating to experimenting and subsequent acquisition of patents during the patent agent's fees are allowed to be capitalized, but fee paid for renewal of patents is a revenue charge. In the next lecture, we will discuss about deferred revenue expenditure.